Quick note, this is for educational purposes only and not financial advice. Any decisions you make are your own responsibility, and trading involves risk. The single greatest shift a trader must make is moving from deterministic thinking to probabilistic thinking. Most individuals enter trading with a deeply ingrained belief that outcomes can be predicted with enough information, enough analysis, or enough skill. This belief is not only incorrect, it is structurally dangerous. Markets do not reward certainty, they punish it. What markets reward is the ability to operate effectively under uncertainty. When you look at any single trade, you are dealing with an unknown outcome. No matter how strong the setup appears, no matter how aligned the indicators are, no matter how convincing the narrative feels, the result of that trade is uncertain. This is not a flaw in your analysis. It is the nature of markets. The mistake most traders make is assuming that uncertainty can be eliminated. Professional traders understand that uncertainty must be managed, not removed. Thinking in probabilities means accepting that every trade is just one event in a large series of outcomes. That single outcome is irrelevant in isolation. What matters is how your strategy performs over a large sample size. This is a fundamental shift. Instead of asking, will this trade work? The correct question becomes, does this trade fit within a system that produces positive expected outcomes over time? This shift removes emotional attachment to individual trades. It changes your relationship with wins and losses. A loss is no longer a failure, it is simply one outcome within a distribution. A win is no longer validation of skill, it is simply another data point. This mindset creates stability, and stability is what allows consistency. Most traders never make this transition. They remain focused on individual outcomes, constantly seeking validation from the market. This creates emotional volatility, inconsistent decision making, and ultimately failure. The professional operates differently. They think in terms of distributions, not predictions. They measure performance over time, not trade by trade. Once you begin to internalize this, your behavior changes. You stop chasing certainty, you stop overanalyzing, you stop reacting emotionally to outcomes. Instead, you focus on execution, process, and consistency. This is the foundation of professional trading thinking. To fully understand probabilistic thinking, you need to understand expected value. Expected value is the mathematical foundation of trading edge. It defines whether a strategy is profitable over time, regardless of individual outcomes. Expected value is not about being right most of the time. It is about the relationship between the probability of winning and the size of wins relative to losses. A strategy with a low win rate can be highly profitable if the wins are significantly larger than the losses. Conversely, a strategy with a high win rate can be unprofitable if losses are too large. This is where most traders go wrong. They focus excessively on win rate. They want to be right. They equate being right with making money. In reality, these are two completely different things. You can be right frequently and still lose money. You can be wrong frequently and still be highly profitable. Professional traders focus on expectancy, not accuracy. They understand that profitability comes from the structure of trades, not the frequency of wins. This is why risk-reward ratios are critical. Every trade must be evaluated not just on its probability of success, but on its payoff structure. If you have a system where your average win is twice the size of your average loss, you do not need to win more than 50% of the time to be profitable. This changes everything. It removes the need to predict accurately. It shifts the focus to managing risk and structuring trades effectively. Expected value also forces discipline. You cannot deviate from your system without affecting your long-term outcomes. Every impulsive decision, every emotional trade, every deviation from your framework distorts your expectancy. Over time, this destroys your edge. Understanding expected value is not optional. It is the core mechanism that determines whether you survive and grow as a trader. Without it, you are simply guessing, regardless of how sophisticated your analysis appears. Another critical component of probabilistic thinking is understanding the random distribution of outcomes. Even if you have a strategy with positive expected value, the sequence of wins and losses will appear random. This is where many traders struggle psychologically. They expect consistency in outcomes. They expect winning trades to cluster together and losing trades to be rare. In reality, losses can cluster. You can experience multiple losing trades in a row, even with a strong edge. This is not an indication that your strategy is broken. It is a normal feature of probabilistic systems. The inability to accept this leads to destructive behavior. Traders abandon strategies after a losing streak. They increase risk to recover losses. They change their approach based on short-term outcomes. All of this stems from a misunderstanding of randomness. You must separate outcome from process. A good trade can result in a loss. A bad trade can result in a win. This is one of the most difficult concepts for traders to internalize. The market does not reward good behavior in the short term. It rewards consistency over the long term. If you judge your performance based on individual outcomes, you will constantly misinterpret feedback. You will reinforce bad habits and abandon good ones. This is why professionals track performance over large sample sizes. They understand that only over time does the true edge reveal itself. Randomness also means that you cannot control outcomes. The only thing you control is your execution. This is a critical distinction. Once you accept this, you stop trying to control the market. You focus entirely on controlling your actions. This creates a significant psychological advantage. You are no longer emotionally tied to outcomes. You are focused on process. This is where consistency begins to emerge. Outcome independence is the next layer of probabilistic thinking. It means that each trade is independent of the previous one. The result of your last trade has no influence on the next trade. This seems obvious, but in practice, most traders behave as if outcomes are connected. After a series of losses, traders become hesitant. They reduce risk or avoid taking valid setups. After a series of wins, they become overconfident. They increase risk or take lower quality trades. Both behaviors are irrational. They are driven by emotional responses to recent outcomes. This is known as recency bias. It distorts decision making and leads to inconsistency. Outcome independence eliminates this bias. It forces you to treat each trade as a standalone event within a larger system. Your job is not to react to what just happened. Your job is to execute your strategy when conditions are met. Nothing more, nothing less. This requires discipline and emotional control. Professional traders operate with this mindset. They do not celebrate wins excessively. They do not dwell on losses. They remain neutral. Their focus is always on the next valid opportunity, executed according to their framework. This neutrality is not a lack of emotion, it is controlled emotion. It is the result of understanding that outcomes are not within your control, only your actions are. When you achieve true outcome independence, your performance stabilizes. You stop making reactive decisions. You stop deviating from your plan. You operate with consistency, regardless of recent results. This is one of the defining characteristics of professional traders. The law of large numbers is what ultimately validates probabilistic thinking. It states that over a large number of trials, the actual results will converge towards the expected outcome. In trading, this means that your edge only becomes visible over time. This is why patience is critical. You cannot judge a strategy based on a small sample size. 10 trades, 20 trades, even 50 trades may not be enough to determine whether your system is effective. You need a sufficiently large data set. Most traders do not have the patience for this. They expect immediate results. When those results do not materialize, they abandon their approach and search for something new. This constant switching prevents them from ever realizing an edge. Consistency is what allows the law of large numbers to work in your favor. If you execute your strategy consistently over a large number of trades, your expected value will manifest. If you do not, it will not. This is why discipline is more important than intelligence in trading. You do not need to be the smartest person in the market. You need to be the most consistent. The law of large numbers also reinforces the importance of risk management. If your risk per trade is too high, you may not survive long enough for your edge to play out. This is where many traders fail. They have a viable strategy, but poor risk management leads to large drawdowns that eliminate them before the probabilities can work in their favor. Understanding this changes your approach. You stop seeking short-term validation. You focus on long-term execution. You measure performance over meaningful sample sizes. This is how professionals think. Once you begin to think probabilistically, your entire approach to trading shifts. You no longer see the market as something to be predicted. You see it as a system of opportunities with varying probabilities and payoffs. This changes how you evaluate trades. You are not looking for certainty, you are looking for asymmetry. You want situations where the potential reward outweighs the risk, even if the probability of success is not high. This is a critical distinction. Many traders avoid trades that do not feel certain. In doing so, they miss opportunities with strong expected value. Professionals do the opposite. They seek trades where the risk-reward profile is favorable, regardless of how the trade feels. This requires a structured decision-making process. You must define your criteria clearly. You must know what constitutes a valid setup. You must understand the probabilities and payoffs associated with that setup. Once this is defined, your job is simple. Execute when conditions are met. Do not execute when they are not. There is no room for interpretation or emotion. This removes a significant amount of cognitive load. You are not constantly analyzing and second-guessing. You are following a predefined framework. This creates consistency. Over time, this consistency leads to improved performance. Not because you are predicting better, but because you are executing better. This is the essence of professional trading. One of the most powerful benefits of probabilistic thinking is the reduction of emotional stress. When you stop trying to predict outcomes, you remove a significant source of pressure. Most traders experience stress because they feel responsible for the outcome of each trade. When a trade loses, they interpret it as a personal failure. When a trade wins, they feel validated. This creates an emotional roller coaster. Probabilistic thinking eliminates this. You understand that outcomes are not within your control. Your responsibility is execution, not results. This creates emotional stability. Emotional stability is not just a psychological benefit. It has direct performance implications. When you are emotionally stable, you make better decisions. You follow your plan. You manage risk effectively. You avoid impulsive behavior. This is why psychology is so critical in trading. It is not about eliminating emotions. It is about managing them effectively. So, probabilistic thinking provides the framework for this. When you internalize these concepts, trading becomes less stressful. It becomes more systematic. You are no longer reacting to the market. You are operating within it with a clear structure and defined expectations. This is what allows traders to sustain performance over the long term. Another key aspect of probabilistic thinking is accepting uncertainty without hesitation. Many traders hesitate when entering trades because they are seeking confirmation. They want additional signals, additional validation, additional certainty. This hesitation often results in missed opportunities or poor execution. By the time the trader feels comfortable, the opportunity has passed or the risk-reward profile has deteriorated. Professionals do not wait for certainty. They act when probabilities are favorable. They understand that uncertainty is always present. Waiting for it to disappear is futile. This requires confidence in your system, not confidence in individual trades, but confidence in the overall framework. You must trust that over time your edge will play out. This trust is built through experience and data. It is not blind belief, it is the result of understanding your strategy, testing it, and observing its performance over time. Once this trust is established, execution becomes easier. You are no longer second guessing, you are following a process. This is where many traders struggle. They lack a clearly defined system. Without it, they cannot develop confidence. Without confidence, they hesitate. This hesitation undermines performance. Building a robust framework is essential. It provides the foundation for probabilistic thinking and consistent execution. It is important to recognize that probabilistic thinking is not intuitive. It goes against how most people are conditioned to think. In everyday life, outcomes are often linked to actions in a direct way. In trading, this link is distorted by randomness. This creates cognitive dissonance. You can do everything correctly and still lose. You can make mistakes and still win. This challenges your understanding of cause and effect. To overcome this, you must consciously rewire your thinking. You must train yourself to evaluate decisions based on process, not outcomes. This requires deliberate effort. One effective approach is journaling. Document your trades, not just in terms of outcomes, but in terms of execution. Did you follow your plan? Did the trade meet your criteria? Was your risk management appropriate? Over time, this creates a clear distinction between good decisions and good outcomes. You begin to see patterns. You identify strengths and weaknesses. This accelerates learning. Without this structure, it is very difficult to improve. You remain reactive, constantly adjusting based on recent results. This leads to inconsistency. Rewiring your thinking is not a one-time process. It is continuous. It requires constant reinforcement. But once it becomes ingrained, it transforms how you approach trading. Ultimately, thinking in probabilities is what separates professional traders from amateurs. It is not about intelligence, access to information, or analytical tools. It is about how you interpret and act on uncertainty. Professionals accept uncertainty as a constant. They build systems that operate within it. They focus on execution, risk management, and consistency. They measure performance over time, not trade by trade. Amateurs do the opposite. They seek certainty. They react to outcomes. They focus on being right rather than being profitable. This leads to emotional decision-making and inconsistent results. The transition from one mindset to the other is not easy. It requires discipline, patience, and self-awareness, but it is essential for long-term success. As you continue to develop as a trader, this mindset will become increasingly important. It will influence every decision you make. It will determine how you handle wins and losses. It will shape your overall performance. If you can internalize probabilistic thinking, you will have a significant advantage. Not because you can predict the market, but because you can operate effectively within its uncertainty. That is the foundation of professional trading. So, at this stage, it is important to confront a subtle but critical misconception. Many traders believe they understand probabilities because they intellectually accept that outcomes are uncertain. However, intellectual understanding is not the same as behavioral alignment. The real test is how you behave under pressure, particularly during drawdowns or streaks of losses. When a trader experiences 5 or 6 losses in a row, the theoretical understanding of probabilities is often overridden by emotion. Doubt begins to creep in. Questions arise about whether the strategy still works, whether market conditions have changed, or whether recent losses indicate a deeper flaw. In most cases, this reaction is not based on data, it is based on discomfort. Probabilistic thinking requires that you predefine what is statistically normal for your strategy. If your system historically produces losing streaks of 8 trades, then a sequence of 5 losses is not a problem. It is expected. Without this context, every losing streak feels like a crisis. This is why data is essential. You must know your system's characteristics. What is the average win rate? What is the typical drawdown? What is the longest historical losing streak? These are not theoretical questions. They are operational requirements. Once you have this data, you create boundaries. You define what is normal and what is abnormal. This allows you to respond rationally rather than emotionally. If outcomes fall within expected parameters, you continue executing. If they fall outside, you investigate. This structured approach removes ambiguity. It replaces emotional reaction with data-driven decision-making. This is how professionals maintain consistency under pressure. Another important concept is the distinction between edge and outcome variance. Even with a strong edge, outcomes will vary significantly over short periods. This variance is often misunderstood and misinterpreted. Traders tend to attribute short-term results to skill or lack of skill. A winning streak is interpreted as confirmation of ability. A losing streak is interpreted as failure. In reality, both can be heavily influenced by randomness. Variance is the natural fluctuation around expected value. It is unavoidable. The key is not to eliminate it, but to understand and manage it. This requires a longer-term perspective. Professional traders evaluate performance over meaningful sample sizes. They do not draw conclusions from small datasets. This is critical because small samples are highly susceptible to variance. They do not provide reliable information about underlying performance. This is also why over-optimization is dangerous. When traders build systems based on limited data, they often mistake noise for signal. They optimize for past conditions that may not persist. This creates fragile strategies that fail in live markets. Understanding variance forces humility. It reminds you that short-term results are not definitive. It encourages patience and discipline. It prevents overconfidence during winning periods and excessive doubt during losing periods. This balance is essential for long-term success. Let's now consider the role of confidence within a probabilistic framework. Confidence in trading is often misunderstood. It is not about believing that a specific trade will work. That type of confidence is misplaced and often leads to excessive risk-taking. True confidence comes from trust in your process. It is built through repeated execution and observation of outcomes over time. It is supported by data, not emotion. When you have confidence in your process, you do not need to convince yourself that a trade will succeed. You simply recognize that the trade meets your criteria and execute accordingly. This removes internal conflict. Lack of confidence, on the other hand, leads to hesitation, inconsistency, and second-guessing. Traders hesitate to enter trades, exit prematurely, or alter position sizes based on feelings rather than rules. This destroys consistency. Building confidence requires deliberate practice. You must define your strategy clearly, test it, and execute it consistently. Over time, you observe how it performs, you see the distribution of outcomes. This builds trust. Confidence is therefore a byproduct of disciplined execution and data collection. It cannot be manufactured through positive thinking or motivation. It must be earned through experience. This distinction is critical. It shifts the focus from emotional reassurance to structural development. One of the practical challenges in probabilistic trading is maintaining consistency in position sizing. Many traders adjust their size based on recent outcomes, increasing risk after wins and decreasing it after losses. This behavior is driven by emotion, not logic. From a probabilistic standpoint, this is irrational. If each trade is independent, then your position size should be consistent relative to your risk management rules, not influenced by recent results. Adjusting size based on outcomes introduces variability that is not aligned with your edge. It distorts your expected value. Over time, this can significantly impact performance. Professional traders define their position sizing rules in advance. These rules are based on factors such as account size, volatility, and risk tolerance. Once defined, they are applied consistently. This consistency is what allows the law of large numbers to function effectively. It ensures that your results reflect your strategy, not emotional fluctuations. There are situations where position size may be adjusted, but these adjustments are systematic, not reactive. They are based on predefined criteria, not recent wins or losses. Maintaining this discipline is challenging, particularly during periods of volatility. However, it is essential for preserving the integrity of your probabilistic framework. Another key area where probabilistic thinking applies is trade selection. Not all opportunities are equal. Some trades offer better probability profiles or more favorable risk-reward dynamics than others. The objective is not to trade frequently. The objective is to allocate capital to opportunities where the expected value is highest. This requires selectivity. Many traders fall into the trap of overtrading. They feel the need to be constantly active. This leads to taking marginal setups that do not offer sufficient edge. Over time, this erodes performance. A probabilistic approach encourages patience. You wait for conditions where your criteria are met and the risk-reward profile is favorable. You do not force trades. This selectivity improves overall expectancy. By avoiding low-quality trades, you reduce unnecessary losses. By focusing on high-quality opportunities, you maximize potential returns. This also reduces emotional fatigue. Fewer trades mean fewer decisions, less stress, and greater clarity. This contributes to consistency. Trade selection is therefore not just about identifying opportunities. It is about filtering effectively. It is about saying no to the majority of potential trades and focusing only on those that align with your framework. Let's now address the concept of overfitting, which is a common issue when traders attempt to build probabilistic models. Overfitting occurs when a strategy is excessively tailored to historical data, capturing noise rather than underlying patterns. This creates the illusion of a strong edge. Backtests may show impressive results, but these results do not hold up in live trading. The strategy fails because it was never robust to begin with. Probabilistic thinking requires that you focus on generalizable principles, not specific historical patterns. Your strategy should be based on structural market behaviors, not isolated observations. This means avoiding excessive complexity. The more parameters you introduce, the greater the risk of overfitting. Simplicity often leads to greater robustness. It also means testing your strategy across different market conditions. A strategy that only works in a specific environment is not reliable. It must demonstrate consistency across varying regimes. Understanding this prevents you from chasing perfection in backtesting. Instead, you focus on building strategies that are resilient and adaptable. This is how professionals approach system development. They prioritize robustness over optimization. Another practical application of probabilistic thinking is in managing expectations. Unrealistic expectations are one of the primary causes of failure in trading. Traders often expect rapid growth, consistent wins, and minimal drawdowns. These expectations are not aligned with reality. Even the best strategies experience losses and drawdowns. Growth is not linear, it is uneven and often volatile. By understanding probabilities, you set realistic expectations. You recognize that losses are part of the process. You accept that drawdowns will occur. You focus on long-term performance rather than short-term fluctuations. This alignment between expectation and reality reduces frustration. It prevents emotional reactions to normal market behavior. It allows you to remain disciplined. Expectation management is therefore not just psychological, it is structural. It is based on understanding the characteristics of your strategy and the nature of markets. This creates a more stable trading environment. You are not constantly reacting to perceived problems that are in fact normal. Probabilistic thinking also influences how you interpret market information. Markets generate a vast amount of data, much of which is irrelevant or misleading. Without a structured framework, it is easy to become overwhelmed. A probabilistic approach helps you filter information. You focus on data that impacts your edge. You ignore noise. This is critical because overanalysis can be just as damaging as underanalysis. Too much information leads to indecision and hesitation. It creates conflicting signals and reduces clarity. Professionals define what information matters within their framework. They focus on key variables and ignore the rest. This creates efficiency. It also reduces cognitive load. You are not constantly processing unnecessary information. You are focused on what is relevant to your strategy. This clarity improves decision making. It allows you to act decisively when conditions are met. Another important aspect is understanding that probabilities are dynamic, not static. Market conditions change, volatility shifts, participant behavior evolves. As a result, the probabilities associated with your strategy may also change. This does not mean you should constantly adjust your approach. Frequent changes introduce instability. However, it does mean you must monitor performance and remain adaptable. If your strategy's performance deviates significantly from expectations over a large sample size, it may indicate a structural change in the market. This requires investigation. Adaptation should be systematic, not reactive. You analyze data, identify changes, and adjust your framework accordingly. This is a measured process. This balance between consistency and adaptability is critical. Too much rigidity leads to stagnation. Too much flexibility leads to inconsistency. Professional traders manage this balance effectively. They maintain a stable core framework while remaining responsive to structural changes. Bringing all of these elements together, probabilistic thinking becomes the foundation of your trading approach. It influences how you evaluate trades, manage risk, interpret outcomes, and adapt to changing conditions. It is not a single concept. It is a framework that underpins every aspect of decision making. Without it, you are operating in a reactive, emotionally driven manner. With it, you operate systematically. You understand the role of uncertainty. You focus on expected value. You accept variance. You maintain consistency. You adapt when necessary. This creates a significant advantage. not because you eliminate uncertainty, but because you navigate it effectively. As you progress, this mindset will become increasingly important. It will shape how you approach more advanced concepts, from risk management to strategy development. It is the foundation upon which professional trading is built. At a more advanced level, probabilistic thinking begins to influence not just how you execute trades, but how you allocate capital across opportunities. This is where traders transition from thinking in isolated trades to thinking in distributions of risk and return across a portfolio of decisions. Each trade is no longer viewed as a standalone event. Instead, it is one component within a broader system of capital deployment. The objective is not to maximize the outcome of a single trade, but to optimize the overall distribution of outcomes across all trades. This requires an understanding of how different trades interact. Some trades may have similar drivers, meaning they are effectively the same risk expressed in different ways. Others may be independent, providing diversification. From a probabilistic perspective, concentration of similar risks increases the likelihood of clustered losses. Diversification, when applied correctly, smooths the distribution of outcomes. This does not eliminate losses, but it reduces the probability of extreme drawdowns. Professional traders therefore think in terms of exposure, not just individual positions. They assess how each trade contributes to overall risk. They avoid unintentional concentration. They manage correlation. This is a more sophisticated application of probabilistic thinking. It moves beyond individual expectancy and into portfolio level optimization. It is essential for scaling capital effectively. Another dimension to consider is the asymmetry of information and how it interacts with probability. Not all participants in the market operate with the same level of information, speed, or resources. This creates structural inefficiencies. However, it is important to understand that having more information does not eliminate uncertainty. It may improve probabilities at the margin, but outcomes remain uncertain. This is a critical distinction. Retail traders often believe that if they had access to better data or faster execution, they could achieve certainty. This is incorrect. Even at the institutional level, uncertainty is a constant. What differentiates professional participants is not the elimination of uncertainty, but the ability to price it more effectively. They assess probabilities more accurately and structure trades accordingly. This reinforces the importance of focusing on process rather than information. While data is important, it must be interpreted within a probabilistic framework. Without that framework, additional information simply creates noise. Understanding this prevents you from overvaluing information and undervaluing structure. It keeps your focus on what truly matters. Let's now examine the relationship between probability and timing. Many traders place excessive emphasis on timing precision, believing that perfect entries are critical to success. From a probabilistic standpoint, timing is important, but it is not the primary driver of performance. What matters more is positioning within a favorable risk-reward framework. A trade entered slightly early or slightly late can still be profitable if the overall structure is sound. Conversely, a perfectly timed entry with poor risk-reward characteristics is unlikely to produce consistent results. This is a key shift in thinking. You move away from trying to optimize entry points and towards optimizing trade structure. This includes defining risk clearly, identifying potential reward, and ensuring the trade aligns with your overall framework. Professional traders often scale into positions. This approach acknowledges uncertainty in timing. Instead of attempting to pinpoint the exact entry, they build positions progressively as conditions develop. This reduces the impact of timing errors and aligns execution with probabilistic thinking. It is a more flexible and robust approach. Another advanced concept is the role of skew in trading distributions. Not all strategies produce symmetrical outcomes. Some generate frequent small gains with occasional large losses. Others produce frequent small losses with occasional large gains. Understanding the shape of your distribution is critical. It influences how you manage risk, how you size positions, and how you respond to outcomes. For example, a strategy with positive skew may have a low win rate but large winners. This requires patience and discipline, as losses will occur frequently. Without a probabilistic mindset, traders may abandon such strategies prematurely. Conversely, a strategy with negative skew may feel comfortable due to frequent wins, but it carries the risk of significant losses. Without proper risk management, these losses can outweigh the gains. Professional traders understand their distribution. They align their behavior with it. They do not expect outcomes that are inconsistent with the structure of their strategy. This alignment is essential. It ensures that your expectations, behavior, and strategy are all consistent. Probabilistic thinking also changes how you approach mistakes. In a deterministic mindset, mistakes are often judged based on outcomes. A losing trade is seen as a mistake, and a winning trade is seen as correct. This is fundamentally flawed. As discussed earlier, outcomes are influenced by randomness. A correct decision can lead to a loss, and an incorrect decision can lead to a win. From a probabilistic perspective, a mistake is defined by deviation from process. If you follow your framework and the trade loses, it is not a mistake. If you deviate from your framework and the trade wins, it is still a mistake. This distinction is critical for learning. It ensures that you reinforce good behavior and correct bad behavior, regardless of outcomes. Professional traders conduct regular reviews of their trades. They analyze execution, not just results. They identify patterns of behavior. They refine their process. This continuous feedback loop is what drives improvement. Without it, learning is distorted by randomness. Another important element is the concept of opportunity cost within a probabilistic framework. Every trade you take consumes capital and attention. This means that choosing one trade implicitly means rejecting others. If you allocate capital to low-quality opportunities, you reduce your ability to participate in higher quality ones. This has a direct impact on overall performance. Probabilistic thinking encourages prioritization. You focus on trades with the highest expected value. You allocate capital accordingly. You avoid spreading yourself too thin. This requires discipline. It is often tempting to take multiple trades, especially when markets are active. However, activity does not equate to productivity. Professional traders are selective. They understand that fewer, higher quality trades often produce better results than frequent, lower quality ones. This selectivity improves efficiency. It aligns capital allocation with expected outcomes. Let's now consider the psychological resilience required to operate within a probabilistic framework. Even with a strong understanding of probabilities, execution under real conditions is challenging. Losses still feel uncomfortable. Drawdowns still create pressure. The difference is how you respond to these situations. Probabilistic thinking provides a framework for resilience. It allows you to contextualize losses. You understand that they are part of the distribution, not anomalies. This reduces emotional impact. It prevents panic. It allows you to continue executing your strategy. However, this resilience must be developed. It is not automatic. It requires exposure to real trading conditions and deliberate practice. Over time, as you experience different market conditions and observe how your strategy performs, your confidence and resilience increase. You become less reactive and more stable. This stability is a key characteristic of professional traders. Another advanced application is the integration of probabilistic thinking with market regimes. Probabilities are not constant across all conditions. They vary depending on the environment. A strategy that performs well in trending markets may struggle in ranging conditions. The probabilities associated with that strategy change as the market regime shifts. Professional traders recognize this. They do not apply strategies uniformly across all conditions. They adjust based on the environment. This does not mean constant changes. It means understanding when your edge is most effective and when it is not. It means reducing exposure in unfavorable conditions and increasing it when conditions align. This is a more nuanced application of probability. It requires awareness of broader market dynamics and the ability to adapt accordingly. It also reinforces the importance of context. Probabilities are not absolute, they are conditional. As you integrate all of these concepts, your perception of trading evolves. You begin to see it not as a series of predictions, but as a structured process of decision making under uncertainty. Every action is guided by probability. Every decision is evaluated in terms of expected value. Every outcome is contextualized within a distribution. This creates clarity. It removes ambiguity. It replaces emotional reaction with structured thinking. You become less focused on being right and more focused on being consistent. You measure success not by individual trades, but by long-term performance. This shift is transformative. It changes how you approach every aspect of trading. Ultimately, thinking in probabilities is not just a technique. It is an operating system. It defines how you interpret information, how you make decisions, and how you respond to outcomes. Without it, trading becomes reactive, emotional, and inconsistent. With it, trading becomes structured, disciplined, and sustainable. This is what allows traders to operate at a professional level. It is not about eliminating uncertainty. It is about embracing it and building systems that function within it. As you move forward, this mindset will underpin everything you do. It will shape your approach to risk, execution, strategy, and performance. If you internalize this fully, you move beyond the mindset of a participant trying to predict outcomes and into the mindset of a professional managing probabilities. That is the shift that defines long-term success in trading.